What's going on, trading world? Welcome to the first episode of Free Education Mondays. I'm gonna try to release a video every single Monday around a certain topic, how that topic affected me, and all the technicals that you need to know about that certain subject. For today's video, we are talking about risk management, why I think it's super important, everything around risk management, and how I lost $30,000 my first year of trading. And if you haven't already, hit that subscribe button so you don't miss these videos every single Monday. All right, in just a couple of minutes, we're gonna go into my computer and I'm gonna basically break down, the theory of risk management, and then we're gonna go into like how to calculate lot sizes, how to think of in terms of percentages and not dollar signs, and other really key important things about risk management, because I think risk management for me, it falls under the 3 pillars of success for trading. So number 1 is always risk management. Number 2, you gotta have a good strategy. And number 3 is your psychology. If you are not perfect in these 3 things, it's gonna be really tough for you in trading Forex. I think these 3 things you gotta work at super hard. Psychology is kind of the last one you master. Strategy is typically the first thing you kind of, come close to mastering. Some people will be better at mastering risk management first. I was not one of those people, and that is why I lost so much money my first year of trading, man. First year I started trading, I knew this is what I wanted to do. I found a course online. It wasn't a cheap course, but it was a good course from what I could see. I bought the course and I messaged the guy who ran the course, real good trader. And I said, man, I've been trading for the last 3 months. All I've been doing is losing money. Is there anything that you can, suggest to me while I do your course and I'm trading at the same time? And he got back to me in a little bit and he said, all you gotta do is manage your risk. And I was like, what? What do you mean manage your risk? Then he said, risk 1% of your account balance. And I was like, what? Because my account balance at that time was like $3,000 on Binance, right? So he's like, risk 1%. And 1% of $3,000 was like $30. I couldn't even comprehend that because I was trying to make like $10,000 a month. I didn't know that, I had no clue how risk management worked. I had no clue why this person kept telling me to risk 1%, but now I understand. So what we're gonna do is we're gonna jump into my computer. I'm gonna go through some of the stuff that I'm gonna be sharing today. I'm also gonna be sharing another 1 or 2 stories around risk management and how I lost more money and why it's important for your psychology as well. And even if you have a $100 account, $200 account, $300 account, it doesn't matter. You should always risk 1% or less. And I'm gonna tell you exactly why. So let's jump.
All right, what's going on, everybody? Welcome to the first episode of Free Education Mondays. Probably gonna be posting way more in April. Got some really good content I want to cover, but I wanted to start with risk management. Now, this is a video I didn't really want to make because this information is pretty freely available everywhere. All right, if you've ever done a Forex course, or if you've even on, like most of you know what it is, okay? But I just want the reason I'm making these videos is I was thinking I wanted to make videos that I used to actually search up and look for, and then I'm going to give you my thoughts and kind of my experience and what happened with me. So when I lost that $30,000 the first year of trading, it could have easily been avoided. I think I could have lost much less. I think it's important to lose money in the start because that's when you get burned, right? I had access, and the reason I'm making this video is I had access to a course that had risk management videos. I had YouTube. So I can't say I didn't have that information at that time, because I did, but it was just I wasn't ready to engage in that conversation. I wasn't ready for my mentor to tell me, look, you got to risk 1%, which is $30, and you're going to make $90 back. I wanted to make, with my $3,000, I wanted to make $3,000 every day, because that's what I thought trading was. It was like you just, you're going to be balling out of control. That's not what it is, man. And so I wasn't ready to have that conversation about risk management. So I spent the whole year just losing money for no reason. So, and then when I did get burned and when I did lose all that money, that's when I was ready to watch a risk management video. That's when I was ready to take notes and put them on my wall. So, you may be in a situation where, there's 3 things where you're typically messing up in, okay? That I think are the 3 pillars: strategy, psychology, and risk management. All right. The first thing I would always look at is risk management. Look at your MT4, study the trades that you've taken in the last 3 months. If it's a personal account, I can almost 100% guarantee you're not following your risk management rules to the T. And if it's a funded account, you might want to really review how many trades a day are you taking. Are you over risking per day or per week? I hope that you're risking 1% on a funded account, because you're not going to lose much if you are not. So I just want to look at 3 things I know you guys probably know them, but hear my take on them. And if you're a little confused about risk management, this is going to be a great video for you. So what is risk management, right? Okay, so look, trading the Forex market is a very, very, very difficult thing to do. It's not easy by any means, man. It is not easy by any means. We as retail traders have no control over whether the market is going to go up, down, sideways. Like, we have zero control. All right, we try to make an educated guess. Okay, sometimes it's even hard to control your emotions, but there's one thing that you do have control over, and that's your risk. So if you have control over your risk, you need to be able to implement that every single trade. Okay, and we're going to come back to what is risk management and how to maintain it. Number 2 is thinking like a risk manager. Okay, what does that really mean? Thinking like a risk manager. My first mentor ever told me, your job is not a job of a trader. You're a trader second, but you're a risk manager first. What does that mean? That means you're always looking at managing your risk. How can I manage my risk better? How can I risk less but make more? That's why you're going to look at people who are using basic strategies but are making good money, or you're going to look at people who are using complex strategies and making no money. It's because when you put up a really good risk manager versus a really good trader who has poor risk management, the really good risk manager will always win with worse technicals but better management of the risk. Okay, and you'll see that, you can see that in people. I can tell, if I'm looking at people who are in the community, or if you look at people on Instagram, there's people using basic strategies, but they're really good with their risk. And so that's why this, as boring of a subject as it is, it can possibly be your make or break, right? Number 3, looking at percentages and not dollar signs. So, you always got to think of, if I'm risking 1%, how I should make 2% or 3%. That's why when you have people on Instagram showing that I made 1,000 pips, I made 300 pips, or I made 300, like I made $3,000, I made it doesn't matter, man. That none of that shit matters, because you can make $1,000 with 10 pips, or you can make $1,000 with 1,000 pips. Really, what it comes back down to is percentages, right? So anyways, that's why. So number 1, risk management is extremely important, because it could be the make or break of your trading. It can propel you from a break-even trader into a profitable trader, or a losing trader to a break-even trader. It's levels there's levels, right? You can just kind of move to the next level. So I think majority of the reason I lost that $30,000 was I was over leveraging. There was no risk management, and when you're over leveraging and you're not managing your risk, what's going to happen? Your emotions are going to get stirred up, and when those get stirred up, you turn into a gambler. You're just trying to make your money back at that point, right? So we're going to look at how to calculate lot sizes to better help manage risk. And the reason that another reason I'm making this video is I've had people DM me and say, I'm doing a $200,000 FTMO challenge. What lot size should I use? Right? That's pretty scary. Like, if you're spending $500 to $1,000 on a risky challenge, and you don't even know how to calculate a lot size, it's not looking too good, man. So we're gonna just jump into lot sizes, how to calculate them, and how to think more like a risk manager. Okay, so you have 2 options you have lots of options in terms of FX lot size calculators. The best one I like, or I used to use before, was this one right here. And for the sake of this video, we're going to use this. You can Google lot size calculator, and for my FX books, this comes up. If you have an iPhone, there's an app called Stinu. It's a paid app. It's like, I think $14 a year. I just use that. It's just easy on my phone. I do it right away and I enter my trade. Okay, but for the sake of this video, you can save this as a favorite, and you just pick which currency you're trading. So we'll just stick to Euro USD. And for the sake of this video, let's just say you're doing a challenge, and it's a $100,000 challenge. You're always going to be risking 1% or less. And let's say your stop loss is 20 pips. You hit calculate, and it spits out gives you a unit sizing, which is 5 lots. That's what you should risk if you want to lose $1,000. Let's say your stop loss was 23 pips. All right. So you should risk 4.35 lot. So I calculate this before I enter any trade always, because this will make sure that when I lose the trade, because look, losing is, it's gonna happen. You're gonna lose you're gonna lose more than you win majority of the time. If you're a good risk to reward trader, majority of the time you're gonna lose more trades than you're gonna win. But when you win, you're gonna win bigger than you lose. So this makes sure that when I do lose, I lose $1,000, like right on, like close to 1,000. Maybe it's like $20 up or down, whatever, because it's spreads and commission. But typically that's what I like to lose, right? And now on most funded accounts, I actually risk less. I risk 0.5%. But let's say you want to risk 1%, right? You should be okay as a risk manager. You should be okay with losing $1,000. Like that should be 100% okay with you. If you lose, it shouldn't even like hurt. It should make no difference. You should just be able to go about your day and do whatever you want. But if it's like something that's starting to hurt, and you're like it's messing up your day almost, you know what I mean? Like, because I used to do that. I used to risk so much, and then the rest of the week I'd be like depressed and like sad. It should be an amount that should make no effect on you, so that typically 1% of your account size, you're okay, because even if you lose 10 trades in a row, you're only down 10% of your account. You can get that back. And then that's where being a good risk manager comes in, right? Like you need to accept the risk before you go into the trade. A lot of people with small accounts, like $1,000, $2,000, they're always like, oh, I found a really good trade. I'm gonna make $300-$400 on this. They never consider the fact that what if I lose the trade? I'm gonna lose $200 on my $1,000 account. That's 20% of your account gone. You can't tell me that's not gonna hurt. That's gonna hurt. Just trust me, it's gonna hurt. So that's where you gotta be a good risk manager, right? You gotta always think about, sometimes you can find a really good trade and you want to risk more. It's better to just stay consistent. Always stay consistent, because this will ensure that your emotions do not get stirred up, your psychology does not get messed up, and you can actually enter. If you lose, that's fine. You can enter the next best trade and make that money back. All right. Keeping this video nice and short, because I know majority of you guys know this topic already, but for the people that don't, we're going to cover the basics, right? How to think in terms of percentages and not dollar signs. So what does that really mean? Okay. That's like, you need, if you're risking 1%, you should aim and try to make at least you should try to make 3%. All right. That's how it's called, risk to reward ratio of 1 to 3. Because if you're risking 1%, that's, it could be $1,000 or it could be $10. If it's $10, you want to risk $10 and try to make $30. That way, and if you're using the long and short tool on TradingView, it should look like this. Okay, let's say this is like your resistance or your supply zone, and you're taking a short from here. Whenever you draw this tool on, it's always going to be at a 1-to-1 risk RR. So you're risking 1% and you're getting 1%. Now let's say this is where your stop loss actually is. Right here, okay, like 30 pips almost. You want to always try to aim for like a 3R, which is 3%. So you're risking 1%, which could be like $10 or $1,000. And when you actually hit TP, you're gonna make $30 or $3,000. And what this ensures is, and so what you're gonna want to do is put this is your stop loss size. You put it into the calculator, and it will give you your sizing. But this ensures something very simple, which is, let's say you win the first trade, right? You win the first trade, you're basically up 3R, okay? The next trade you're down 1R, and then the next trade you take again, you're down 1R. So your first trade you won 3% of your balance. Next trade you lost the trade, absolutely fine. It's gonna happen. The next trade again, you lose it again, absolutely fine. And you know what? You're like, I'm gonna call it a week, call it a day, whatever. Shouldn't really be taking that many trades per day, but let's say it's, you're like, okay, I'm gonna call it a week, man. It was an all right week. At least you're in the plus. You're still plus 1%. You know what I'm saying? So you're still plus 1%, and then if you win the next trade, you'll be up plus 4%. So just wanted to do this quick video on risk management, just the basics. I know it's nothing crazy, but If you haven't already, please subscribe to the channel. We're going to be doing lots more in-depth subjects coming in April. Working on those videos soon. And with that, yeah, have a wonderful day, everyone.